Until we stabilize the financial system, a sustainable economic recovery will remain out of reach. In particular, the continued viability of systemically important financial institutions is vital to that effort. In that regard, the Federal Reserve, other federal regulators, and the Treasury Department have stated that they will take any necessary and appropriate steps to ensure that our banking institutions have the capital and liquidity necessary to function well, even in a severe economic downturn. Moreover, we have reiterated the U.S. government's determination to ensure that systemically important financial institutions continue to be able to meet their commitments. At the same time that we are addressing such immediate challenges, it is not too soon for policymakers to begin thinking about the reforms to the financial architecture, broadly conceived, that could help prevent similar crises from developing in the future. We must have a strategy that regulates the financial system as a whole, in a holistic way, not just at its individual components. In particular, strong and effective regulation and supervision of banking institutions, although necessary for reducing systemic risk, are not sufficient by themselves to achieve this aim. In a crisis, the authorities have strong incentives to prevent the failure of a large, highly interconnected financial firm because of the risks that such a failure would pose to the financial system and to the broader economy. However, the belief of market participants that a particular firm is considered too big to fail has many undesirable side effects. For instance, it reduces market discipline and encourages excessive risk-taking by the firm. It also provides an artificial incentive for firms to grow in order to be perceived as too big to fail. And it creates an unlevel playing field with smaller firms, which may not be regarded as having implicit government support. Moreover, government rescues of too-big-to-fail firms can be costly to taxpayers, as we have seen recently. Indeed, in the present crisis, the too-big-to-fail issue has emerged as an enormous problem. In the midst of this crisis, given the highly fragile state of financial markets in the global economy, government assistance to avoid the failures of major financial institutions has been necessary to avoid a further destabilization of the financial system, and our commitment to avoiding such a failure remains firm. Looking to the future, however, it is imperative that policymakers address this issue by better supervising systemically critical firms to prevent excessive risk-taking and by strengthening the resilience of the financial system to minimize the consequences when a large firm must be unwound. My forecasting record on this recession is about the same as the win-loss record of the Washington Nationals. It has surprised us in being more severe than anticipated, but again, I think the main lesson that's been learned is how powerful and how pervasive these financial market effects can be. So the way I would phrase my answer would be to say that it depends critically on our ability to get the banking system and the financial system more broadly, not necessarily back to 2005, but back to a situation where the markets are reasonably stable and they can perform their critical function of providing credit to the economy. If we can do that, then I think that there's a good chance that the recession will end later this year and that 2010 will be a period of growth.